The discussion for our next panel is Advanced Risk Management, Return of Exotic Forex Derivatives and Opportunities for the Corporate Treasury. For that, I'd like to call on stage Mr. Maulik Shah, the co-founder and CEO of Almus Risk Consulting LLP. He's going to be the moderator for the next panel. A huge round of applause, ladies and gentlemen. Friends, आप अभी lunch करके आए हो, थोड़ा louder. Let me hear you. Next, I'd like to invite Mr. Anshul Chandak. He's currently the head treasury for RBL Bank. The bank has added various businesses like FX, derivative, and bullion in the product bouquet under its leadership. Prior to RBL Bank, he was associated with HDFC and Kotak Mahindra Bank. His areas of expertise spans across balance sheet and investment book management, debt capital markets, FX and fixed income trading, and Forex, foreign currency fundraising for clients. He's also handling the additional responsibility of overseeing international banking unit located at GIFT City as chairperson of governing body. Next, I'd like to call upon stage Ms. Manaswini Goel. She's currently the head Group Corporate Finance and Treasury, Mahindra Group. She has taken over the role effective 1st November 2022. She has been associated with the Group Corporate Finance function since 2015 to 2020, where she was responsible for Treasury and Banking for M&M and Treasury and Banking Advisory for Mahindra Group. Ms. Manaswini brings with her more than 22 years of experience in Treasury and Finance functions of organizations like the Mahindra Group, HDFC, and National Housing Bank, spanning diversified businesses around the globe. Next, I'd like to call upon Ms. Tanushree Bagrodia. She is the CFO at Laxmi Organic Industries Limited. Ms. Bagrodia's banking career started in London. Her first momentous career success was when she set up a widely acclaimed and profitable collaboration for an Anglo-Belgian investment bank, KBC Financial Products, with one of India's most respected financial services group, Kotak Mahindra. She became amongst the youngest professional CFOs in India in 2013. After a 6.5-year successful tenure in manufacturing, she transitioned to India's fastest unicorn, Udaan.com, as the CFO and head of the enterprise credit at Udaan Capital. And next, I'd like to call upon Mr. Gupta. He is the co-founder and COO of Dhan, a technology-led investing and trading platform. He has been in capital markets for over 18 years and led the digital broking initiatives at Indiabulls, Carvey, and headed the currency desk for Mangal Keshav Group, after which he was the founder and CEO of Malicious Securities. Mr. Jay Gupta. He's just coming? All right. Can we have a huge round of applause for all our panelists, please? Mr. Jay Gupta will be shortly joining us. Till then, we can start, I guess.
Hello. So welcome back, everyone, from the lunch. The topic for this panel is Advanced Risk Management, Return of Exotic Derivatives. The title itself says something, Return of Exotic Derivatives. And in the Indian context, I must say, as far as exotic derivatives journey is concerned, in one line, if I were to sort of describe, it has actually moved from a glamorous girl to the most hated villain, and then become an extinguished alien. 2007-8, something happened. We had the exotic products being used both by the corporates, being sold by the bankers, and then something happened in next 2-3 years. 2011, there was a ban on the product, and now till about, I think, a year back, when Reserve Bank of India came out with a guideline which allowed the return of the exotic product. So we are going to take you through this journey, and I know there will be some controversial topics, and we are going into the past. I think the way we have structured our conversations, I will be moving around the various panels. We will broadly cover the 3 different phases, and I'll also set the context for that. The first one being, we'll slightly dig into the past. May not really be as comfortable, Anshul is already smiling, but we will do that with the only objective that what are the key learnings something that did not work. What are the key learnings, both for the bankers, for the corporates? We'll pick certain learnings from there, and we'll then come to the today's scenario where there are certain existing time frame, existing regulatory frame under which we are looking at this particular product. And given the return of exotic product, how can we as a corporates, how can banks together as an entire ecosystem can actually benefit out of that more for the risk management and maybe some other applications. So that's really the broad theme that I've thought through, and feel free, it's going to be a very free-flowing conversation. So dear panel members, while I know the product, the topic itself may be a difficult conversation, one thing which I can tell you, Almus Conference is known for the free-flowing conversations. There are no media here. I am not Arnav Goswami. Nation does not want to do anything. It is just this community really wants to learn and take away.
I can endorse that over the years.
All right, great. So let's begin the first round. Really, Anshul, I'll start with you and then come to you, Jay, before I come to the corporates. What exactly happened? If you were to really look at, and all of us, I guess, were market participants. I have done the transaction myself in 2007-8. So what was the key things that you would really want to look at it, pick up as a learnings?
Thanks, Maulik ji, for having me over. And I will try to be as honest as I can be.
Thank you. That's what is expected.
So back between 2005 to 10, there were varied exotic products that were sold, barrier options, range accruals, which are leveraged, knock-in, knockouts, TANs. The common theme across all these products were one, highly skewed, payouts, huge counterparty risks that it got associated with, excessive leverage, and shallow depth with a very complex math behind it on how it would get valued. So these were the common, and these are the products that got blamed during global crisis when, for the mounting losses. But the risk that got undermined the most in that period was the voluntarily induced risk in the name of innovation, excessive confidence on payout, and most importantly, ignorance. Of course, financial institutions tasted success while selling these products, but that gave excess confidence and became more speculation than hedging, leading to the construed line as mis-selling. And of course, corporates enjoyed the party till it lasted, and when things went the other side, of course, pleaded for ignorance. So this is the long and short of what happened between that period.
But if you were to really look at that scenario, given that it did not really work the way it should have worked, what are the key learnings that you're picking up?
So, of course, a stronger risk management framework on both sides was a key. So people who would execute the deal, people who would sign the confirmations, and of course, the reporting authorities. All these three, in a lot of those cases, were same. Banks, on their side, of course, the suitability and appropriateness. I think what was on paper and what was on spirit was completely different. And I think we made ourselves more comfortable to put down on paper so that we could execute a certain product. And that was the reality, which of course, when I look back and in all my honesty, now I see, I think we could have done a better job on that. So these are some of them.
So Anshul, you talked about the risk management framework, and let me move on to Jay. Now, the very fact that some risk management practices were compromised or ignored upon. What was the conditions? If you were to really look at what happened in 2007-8, why there was so much of an euphoria to really take risk? Can you just throw some light on that?
See, in macroeconomics, when we all might have read about Keynesian theory, right? So we have heard a term called animal spirit. So in 2006, 7, 8, those times, so the animal spirit was at its all-time highs. So for any bank, says they are in India, if they find their Western counterparts are taking bonuses worth millions of dollars, right? So you have all the more incentive to sell whatever comes on your way. So what happened in 2008 was you sold, you missold because there was some kind of easy availability of money. There was abundant liquidity. The corporates in India were seeing this for the first time. They did not see this before, right? When where a banker comes to you and asks you what amount of money you need. So that was a peak time. And you would have seen in US the kind of subprime thing which were happening, the abundant lending which was happening. So that all resulted, where the mis-selling happened. There was no due diligence done. The corporates, whether they actually were prepared for that risk worthiness or not, that was compromised. And that resulted into the chaos, which we all know about. So in lighter terms, in those era of chasing the animal spirit, the animal was dead, and you had only the spirit which haunted the bankers and the RBI for next 3 years.
Yeah, I think you are highlighting a very good point in terms of there was a risk appetite. The conditions, business conditions were extremely good, and that allowed a corporate to probably compromise and not even look at the downside of the whole thing. And picking up that point, yes, you want to say something before I actually go to the corporate?
No, I think, I wanted to highlight on the key learnings from there. So next, when we have launched this again, it's very important to understand to whom you are selling it, right? What about the sustainability? Are the corporates who are going to buy it are worth, so those frameworks need to be in place. If that framework is in place, then there are further challenges which may come, which we can discuss going ahead.
Yeah, but suitability
that,
and appropriateness was even earlier was there, like Anshul said. Those frameworks were in place. Maybe it was not really highlighted the way it has been done now, but those conditions were or stipulations were anyway there. Still, there was definitely a urge to compromise on it. Like you said, animal spirit, a higher risk appetite. Because I'm making money, it's okay for me to take a risk. Not even look at the downside. And that could be, but that could be on the corporate side. I would be more keen to hear from the bank side. What was it that was probably there for them to really go ahead and be so aggressive? I'm sure there was some element of grade or whatever could be there.
Just to add, the fact remained that, which I think he pointed out rightly, that there was some initial success. And of course, there was a transition on these businesses at bank level as well as at the corporate level, where suddenly corporates also started eyeing treasury as a function where they can make money, while against probably the extended version of the basic principle of protecting and being consistent and hedging. I think that kind of got overwhelmed with this whole money making process, and at the same time banks completely, the kind of targets that were put across for the sales dealers to convert, and this was happening across the industry, so not as if it was restricted to one or two financial institutions.
The pressure to perform.
Pressure to perform. So that's what kind of led to this.
So, Manaswini, I know Mahindra, for that matter, Mahindra and Mahindra is extremely conservative corporate, but you were a market participant. I'm sure you have certain experience. You would have heard some stories. You can throw some light on what was it that probably was not really from a corporate side, and what could be the learnings?
Yeah, thanks, Maulik. Both Anshul and Jay have been actually very candid in accepting what were the, if I may call it, the wrongdoings on the part of the bank. But I also feel that corporates also held a responsibility. And while I've worked at both HDFC and Mahindra, which are known to be very conservative and good governance with proper risk management, but both of them also bore the brunt of the last round when this whole story sort of unfolded. And when I think back, if you really look at what the losses were during those times, there were 3-4 key issues which come to mind because of which the corporates faced all those losses. Most of the losses, were on the borrowing side. So a lot of the borrowings were left actually unhedged. Even when they were hedged, they were maturity mismatches. So if you have borrowed 5-year, but you're doing a 1-year hedge and you're thinking you'll roll it over at a more attractive rate, or you then take a knockout on your hedge. So that actually goes against any risk management principle. So I think a lot of those losses emanated from, this. Secondly, when you think about the past of exotic derivatives, a lot of us, and I would say myself also, thought that the past is the best barometer of the future. So just to give you an example, for example, in dollar yen, it has never gone below 100. So let's take a knockout at 99, and that used to happen in dollar CHF also. So everybody thought, took a lot of comfort in what has happened in the past. So ab aage nahi hoga. And obviously, when the GFC, global financial crisis came and this whole story unfolded, everybody was caught unawares. Secondly, thirdly, I think it was a lot about leverage also. There were a lot of these 1:2 structures, right? So if dollar rupee goes above a certain level, again, people thought that it has never crossed 50 or 49. So, if it goes to 49.5, I will be double hedged, but at 43. So that again goes completely against the concept of risk management. Taking comfort in the past, taking a lot of leverage. And lastly, this was also the era, this was the pre-IFRS era. So in terms of accounting and disclosures, it was a free-for-all accounting, and that was the time when ICAI came back with a guidance, and then obviously subsequently IFRS followed. So accounting was a bit of a free-for-all, and everybody, and also the disclosures, right? So in terms of, and I'm not just saying the disclosures in the annual report, but to the board or the audit committees or the risk committees, there was no framework. There was no, I don't think at that time people really thought about tail risks, that okay, I'm taking a knockout, but if that knockout happens, what is the impact? So I think it was a mix of all these factors, it was just basically a euphoria sort of a moment.
But tell me, how do you still explain? You talked about dollar yen borrowing. I mean, I can understand for Mahindra, you have Japan business, okay? You can still, play in that currency. Rather, you can actually, how do you explain borrowing in CHF, completely unrelated? I mean, what was that?
In plain and simple words, greed. So if you have a rupee borrowing, how can you convert into yen and CHF and gain some carry? So the carry trade was really big, if you recall, in those days. And everybody thought they could reduce their cost of funds. So, that's the answer, short and
Sorry, not just loans, but trade payments as well.
Even
were
trade
hedged.
payments, yes,
Yeah.
yes.
So, it wasn't restricted only to loans. And it, of course, went to a third currency. And there was a process back then, defined by regulator as well on how you could do it. But again, all of that was on paper. And I think lack of disclosures also led to some of the senior folks in the treasuries to kind of go ahead and sign it, seeing, the peer pressure from, other corporate treasuries.
Yeah. So Tanushree, you bring in a lot of international experience. And you have your own experience about the whole 2007-8 and also a great learnings. What's your takeaway on the entire episode?
So Maulik, I'd like to start with a story, right? During 2007-8, I had taken an Indian corporate in London to meet GLG Partners, one of the largest hedge funds in the world. And they'd had a huge loss on derivatives, purely India business. There was absolutely no foreign currency exposure they had. And the GLG Partners senior person sitting there asked the CEO who was there, how do you explain these derivative losses that have happened? And the CEO's face fell, okay? And he said, look, the bankers missold the product to us, and we didn't understand the risks. And then he suddenly became defensive and he said, and we are going to sue the bank now, right? So I came back to the office and, I at that point in time was just setting up the partnership with Kotak Mahindra. And again, Kotak's a very conservative house and a lot of respect for them, right? And started to understand what was happening. And just before I had joined KBC, I was with Merrill Lynch. So just to give a perspective, right? While I think Jay, Anshul, Manaswini have been very candid and said banks missold, I think there's an element to understand over here that the entire MNC banks who were there in the country had been facing challenges in making money in Europe from 2006 onwards. India had been a hot market and they'd been selling these derivative products here. without acknowledging the fact that they didn't have experts on the ground, right? So you don't train your people here, they are not aware, but now you've given them targets to sell. I think it's absolute gross negligence. I think the second aspect that happened was, in London as a banker, I had to pass what was then the Financial Services Authority's exam. And every 3 years, I had to renew it, which meant that guidelines or no guidelines, I had a fiduciary duty to my profession to be able to sell what I understood, what the client wanted, and what the client understood. Now, such a framework even today doesn't exist in India. So to say that the regulator has a framework and you have to follow it, and there is a target that you've been given without being explained to what you are selling, I think it's unfair, right? So I think just having that FSA license and that responsibility made it extremely important for us to take accountability of what we were doing, right? I think similarly on the corporate side, I think Manaswini said it very, very well, right? It was greed. But I think if you look at India even today, the relationship between a banker and a CFO or a banker and a treasurer is that of trust, right? And I think when you had a banker who'd been with you through the tough times when liquidity was not available and was coming and advising you today saying, nahi hoga, and was showing you models, but those models were not completely stitched up, right? Because they were unaware. I think you just believed them. So I think the big learning for me is we have to have the financial services players in India take accountability. It can't just be the regulator, right? The second thing is, I think within the corporate world as well as CFOs, we need to hold off and say, am I looking at, what is the risk reward that I'm looking at? For this particular reward, is the risk non-commensurate? And if it is non-commensurate, then as a CFO, you stand up to the audit committee and to the stakeholder and say, this is not my recommendation. Then if you're overruled,
so
then you're
I'll pick this
overruled.
point and go back to the past. What was exactly, so when you say 2007 and 8, was it not already being practiced or it was all compromised?
It was not being practiced. See, Maulik, I think we need to take back and say derivatives in India is not something which is, and I say this with all humility and all respect to all market participants, derivatives in India is even not understood today. Because we are not a country that, we don't understand the convertible bond product, right? Which is a simple bonds plus warrants. We're the only economy in this whole world that does not use that product to raise money for the small and the mid cap, right? And now suddenly we're talking about exotics. The awareness, education was not there. So it's not that framework was not there or regulations were not there, right? That's why I'm saying if I take an outside-in perspective, I could see, I was sitting in the offices of these banks and seeing how they were keen to expand business in India. And banks have misused the FCCB buyback opportunity in a huge way, right? When RBI came up with a framework saying, these are the caps, you can't buy back beyond that point. Overseas banks have misused that to make money, right? So banks wanted to make money, they didn't have an opportunity, so they pushed. You didn't have the FSA sort of a regulator over here who made the individual accountable. The corporates trusted the banks. It just became a vicious cycle.
Tell me, from your experience, was it only an India-centric phenomena?
So, Maulik, I have to admit, so I have worked very closely in that period with Japan, Taiwan, Korea, China, India, entire Western Europe. Okay? And yes, it was only India. I mean, Taiwanese understanding of derivatives is far more nuanced than ours is. Their market is much deeper. Koreans understand it. Japanese, along with the French, are up there, right? And the Americans. I think, आप आज भी देख लो, let's forget that era, right? Just look at the bonds plus warrants and how they are helping infrastructure, education, healthcare, raise money globally, and where are we today in that journey?
So I think you are highlighting some of the key points in terms of being even readiness today. And that's a very valid point. I want to come to that. Yes, Anshul, you wanted to say?
No, so I just wanted to extend that Tanushree was just trying to mention. The fact is that a lot of these products did transition from these European countries. Secondly, irrespective of the licenses that some of the matured market bankers had, we saw some of the largest scams happening in form of LIBOR and many others. So if license was the only way to kind of have that stamp that you are eligible to sell, then world wouldn't have seen the largest transition in form of LIBOR to SOFR and so on, right? So it wasn't as if people weren't educated. Of course, the maturity levels of markets were different, and I agree. But the fact is that this problem didn't start in India. Actually, the first structures that started going bad were actually in US and Europe. And then, of course, with a lag, that came over to India. And a lot of these, started with rates market and then eventually moved to currency. That's when India was hit more versus some of the matured markets. But the fact is that, yes, there was underinvestment in people. Was it optimal? No, 100%. Was it optimal on the corporate side? For sure, no. But were people completely unaware of what they were selling? No, they were aware. Okay. It, of course, as I said at the start, that it did involve complex math, and banks did a fair bit of investment in, kind of resourcing, the kind of hiring that we do. And unfortunately, with the life cycle of this product, we had to lose a lot of our colleagues. So it's not that as if there was completely no preparation to kind of do it, but was it optimal? No.
So I think it's very important to know from where we are coming today to even look at where we are moving ahead. And I think one of the important point, even Anshul, that you talked about, and to some extent Tanushree that you mentioned, is about the readiness. Now, readiness comes from the entire ecosystem preparation. One of the things that happened, and I know for a fact because I was talking to a friend from a foreign bank, there was we actually exported the intellectual capital. A lot of banks invested into exotic derivative products and the related entire mathematical model. And suddenly in 2011, when we had the ban on those products, we had no opportunity for those talents. If you were to really look at that and look at current scenario, where while there is a regulatory framework, are we really ready? I mean, do we really have those talents as a banker, as a corporates, where we are?
So I think we are much better prepared versus last time. There was a huge learning curve for everybody, including banks and corporates. So the whole framework that has been put across now, and of course it's little more restricted with the number of corporates that are participating right now. But the ones that are far more prepared in terms of the human resource that they have, that they manage these products. And the banks,
the banks or the corporates?
Corporates as well as banks. And banks, of course, have, started preparing. We've, of course, put across smaller teams because the product hasn't kicked off the way we all envisaged. So it's a ongoing investment, and it's not like a one-time thing that you hire one person with a skill set and then do away with it, right? It's a continuous process, and it's very important, which is the point that even Manaswini mentioned, that it's not just one or two people, because the client engagement at the bank level happens at multiple forums, and it is important. And the point which Tanushree mentioned about the trust, and that's very important. And I think that's the learning for bankers. If there is so much trust involved, and we are in the business of trust, we have to be more responsible. And the only way we can be responsible is that be more transparent, be more forthcoming, give everything which is a probable scenario, and then probably let products kind of flow into the system.
So I have a different view on your comment about the corporates, and I'm going to check that with Manaswini. My view on the corporate is neither they are ready nor they are interested in being ready.
Yeah, so in corporates, actually, we have a very unique challenge. When you go to your board and the senior management, derivatives is like, it's a weapon of mass destruction. Yeah. And if you say exotic derivative, you're thrown out of the room. You're like, get lost. Yeah. But when you talk about the treasury teams, especially
and think about a corporate, M&M is talking. Yeah. I mean, I'm leaving aside medium size and the small corporates who do not even have,
Absolutely. But when you talk about that, the new talent which has come, and some of them who've like perhaps joined the workforce in the last 10, 11 years, they have no scars of the past, right? And this is the first time actually, so for them it's like a new toy. Suddenly there is a new product and they think it's a very cool thing and they can now, be at par with their peers in Wall Street and London. So those are the two ends of the spectrum, frankly, as corporates we are dealing with. As a treasurer, I'm more concerned. I think, see, talent can be groomed from a treasury perspective because we have bright minds. I mean, I don't think anybody in this room really doubts about the competency of Indians. What I'm more concerned about is the price discovery process, because forwards, all said and done, have become a very vanilla product. And if people understand, when you go to options and then exotic options, how that price discovery will happen, how will we ensure transparency of that pricing, and whether there has been no any other issue around it, that is what I'm more concerned about.
Yeah, I think that's again another point, because especially when it comes to price discovery, today you have a forum market, but at the same time a very liquid exchange market. When it comes to options, you're still relying on OTC market, and exotic derivatives, no way. I mean, there's no other choice where you have to, really have that competitive pricing. Tanushree, your take on really a corporate's readiness for using these products.
Maulik, I think we need to look at, I don't think there is one answer whether corporates are ready or not. I think we still need to acknowledge that for us, we are still in a world where there is a set of corporates who get the talent, who have the ability, and who have the balance sheet strength. Then when you come to the mid caps and the small caps, they don't have the balance sheet strength. They have the requirement of the funds, and they don't even get the talent which is required, right? Now, the talent piece, it can be supplemented with experts such as yourselves, right? Because you can come and guide, you can come and educate. But I think the onus still lies internally. And I think there, the memories of the promoters and the boards is still not able to get over what happened in 2007 and 8, right? So I think there is a little bit of hesitation. My experience as a CFO, and this is where I beg to differ with my, with Anshul and other bankers in this room, I don't think the bankers have still become responsible enough, right? Very recently.
That's a big statement, by the way.
Sorry?
That's a big statement.
No, I'm going to tell you, and I'm going to give you an example to prove this, right? Whatever I'm going to say is public information, so I'm not disclosing anything which is non-public. Laxmi Organic is a net importer. Okay, we recently drew down rupee loan at a fantastically attractive rate. And two banks actually came to us in this absolute desperate push mode, saying, "Isko dollar mein swap kar lo." And I said, why would I do that? Explain this to me, right? And the way I was explained things was where they didn't even have numbers on an Excel spreadsheet. So I had to actually tell those two gentlemen, mid-level, not very junior, that go back and put numbers on a spreadsheet. And just don't put numbers of the transaction. Also put accounting numbers on the spreadsheet and then come back to me. They've not come back to me in the last 3 months. So that probably shows where we are, right? So if that's the market, how do you expect a corporate to get ready? So I think there is a set of corporates who are ready, but by and large, if we forget the larger ones who have all the means and the talent at their disposal, I think this is still a little bit of a journey that we need to travel.
Fair point. Jay, I want to come to you on your comment about certain conditions that existed in 2007-8. Now, as you reflect back, see, one is of course the real economy is doing pretty well. Animal spirit, as we talked about, is slowly gaining momentum. If you were to really look at the maturity curve on specifically the usage of these products, how do you assess? Where do you see today's conditions vis-a-vis what it was earlier?
Uh, well, see, I see it from I see it from two perspectives. First is the corporates which were there in 2008 and now. So I believe there is a lot which has been covered in terms of learning curve. You know, our corporates today are more exposed to international trades. You know, they understand the dynamics of how these exotic derivatives and other financial instruments work. So there, definitely we have moved ahead. In terms of, you know, our readiness, see, when this episode happened in 2011 when RBI actually banned it, so till then for next 10 years, our corporates have worked on kind of forwards, right, which is a vanilla product. So the whole ecosystem here in India is designed, the understanding of the product has been more on the practical side on how you use forwards. Now, if you bring exotics here, most of the, there's no dearth of talent, right? But the knowledge is theoretical. They haven't, you know, created a position and exited from them. So the challenge will come in terms of execution. Again, even if they understand something a little bit, or you have somebody who has an international exposure, he starts working for a corporate in India, the liquidity becomes a challenge, which is not there in international markets or in international companies. So there, there are two things. In terms of manpower readiness, I think we are at a very nascent stage as of now.
Yeah, got it. And I think even in terms of the liquidity that you mentioned, I think overall the total option market itself is hardly about what, 4-5%? Less than that, less than that. And within that exotic products, I think you will probably count few deals. Yeah, so I think that issue still remains. So even if, let's say, we were to talk about being ready for the exotic products, the question really is probably, in terms of the liquidity or the ability to easily enter and exit continues to be a challenge. I want to go to them for the next set of questions, but as I do that, we will still have time for the Q&A. So given the topic, which is very, very interesting, I would want definitely few questions. I mean, you will have the opportunity. You can be ready with your questions. I'll just take them with the last round of my questions and then over to the entire audience. I want to talk about the existing guidelines which came out. Okay, and broadly, if we were to look at it, there are two critical elements. One is it has defined the retail and the non-retail users, and the distinction is 500 CR. And the second, which is more for a bank, that you cannot sell a product which eventually results into the more losses than had the corporates being unhedged. Now, these are the two driving criteria for the guidelines. Now, I really want a reflection on the first one because I'm not too sure. 500 CR, I mean, on one hand, we talk about suitability and appropriateness, and 500 numbers. I mean, how do you, and we have, by the way, a formal regulator in the room, so feel free to share your views on the guideline.
No, actually, I would appreciate the regulator that this time around, the whole framework that they have put across is fairly clear for bankers as well as for corporates. The last time around, the other learning was that some of the areas that were there with product-specific criteria were little more left open for interpretation, and each company and each bank interpreted in their own way, and that led to a lot of leverage structures where the payouts were quite skewed. The risk-reward ratios were not favorable. So this time around, one, of course, the distinction is very clear. What it also kind of signals is the ability to invest to get ready to handle these products, right? So 500, while is just a number, but if banks on their side put across a proper method to the madness on how we do our suitability, how we talk to our client and explain the product, not just on the paper and the term sheet that we put across, the trust factor that was spoken about. If all of that is a deeper engagement, not just at the dealer to dealer level, but of course at the senior level as well, makes a lot of difference. So some of this, in my view, is very important as we start picking up some of these products from here on before we start selling honestly.
Okay, Manaswini, I mean, 500 CR still is a puzzle for me. I mean, what is the sanctity? I can have a corporate beyond 500 CR but no risk management skill set, and a below 500 CR, which can either have in-source or outsource to a firm like us. I mean, we serve a lot of corporates below 500 CR as well. So how do you really distinguish?
Yeah, so Maulik, I don't think, when RBI came out with a 500 CR, it's like a sacrosanct limit. I think they wanted to first, because they were coming out after, 10, 11 years, 10 years, so they wanted to first, I think they want to first see how is the adoption. And typically, before, the smaller, so-called smaller units start looking at it, in my mind, once the market develops and there is a proper use case which comes, because so far, at least from what I know, exotic derivatives are more discussionary than executionary. Like, I don't think many executions have happened. Sorry, not many executions, many trades have happened. I hope there are no executions in the process. So I don't think that's a sacrosanct limit, but I hear your point, and perhaps linking it to the percentage of, how much of your revenue is linked to Forex could be another more mature way of looking at, these thresholds. So.
Okay. Tanushree, independent of forget 500 or those, but you have gone through the guidelines. I mean, your reflections, or from a different standpoint, what probably some of the international practices could be in place, which can in turn either be a part of regulatory framework or part of the operative practice. I mean, your comments.
So I think on the 500 crores, right, one thought that immediately comes to mind is what happens if a company of 1,000 crores net worth has a subsidiary, wholly owned subsidiary, which is a 300 crore net worth. And if this subsidiary can actually have a huge financial benefit by getting into some of the derivative transactions, why is that subsidiary being left out, right? So I think it's unfair. I think in India, the RBI, I don't envy their position. They actually have this very tough job of putting in safeguards, right? Which, and everybody just, anything goes wrong, they'll say RBI ka regulation nahi tha, right? But when those tough regulations actually save us, they don't get any credit for it. But I think we can't paint the entire industry with the same brush. And that's why I'm saying, what about a 300 crore sub that can't use this, but has the wherewithal, the talent, the risk management framework, and can financially benefit, right? So I think that's there. The second point that keeps coming back to me is, and that's on the second point that you made, excessive losses if the company was unhedged versus hedged. I could be just using simple forwards to hedge my export exposure. The currency moves and I'll make a loss. Was I better off hedging or not hedging, right? I think that's a free market for a reason. And I think at some point in time, India needs to start becoming more brave and mature and saying that, let's become a little more free. Could it be the top 1,000 listed companies? Because they anyways have so many compliances, regulations, etc. to do. Can they be a participant of the free market without any of these guidelines? I don't know. But I think that's my view.
So in a way, there is some beginning. Maybe over a period of time, there could be some other yardstick to actually tweak some of those guidelines. Basis the use case, as Manaswini said.
Just to add to her point.
Okay, how much time do we have? I don't have time. Okay, so.
Yeah, derivatives is a need. If you are in international business, if you have to hedge, it's a need. See now, what is the problem going on in the global markets is that the hedges have become an issue. The kind of movements, kind of the market it moved, it is totally different. Even for India, rupee depreciated heavily against dollar. Okay, 3-4 months, 2 months go back. It appreciated against other currencies. It never happened in our history. Okay. So it's a need. Derivatives is need. I think why RBI opened it up, as we said, bit bold, bit aggressive, bit freedom, which you are all seeking. That is why they have done it. Okay. Definitely there is no 2011 is forgotten according to me. Okay, so what the corporates should have is, yeah. So execution, risk management and value addition and how it is measured and managed, that is critical. Over to sir.
No, first of all, I think, give me a minute. When the first issue happened, I was very much in Reserve Bank. I don't think there was any doubt about what the banks could do and cannot do. What they did was different. It was in my own hand that we wrote that circular which said that you cannot offer a derivative which takes him to a position worse than unhedged, which means not the kind of thing which Tanu is saying, but which means that you cannot offer a leverage product. That's as simple as that. If his loss is on account, it can be only that X. It cannot be 2X or 3X. That cannot be done. That was broken. Now, when the mark to market was positive, no corporate complained. So to the question that they asked the question of how did you do it, I mean, nobody complained. But the thing which hit Reserve Bank of India at that point of time, I was very much in that meeting. When we asked some of these banks, many of them foreign banks, how did you price the product? No answer. We got this price from London, we have offered. But what are the components which have gone into the pricing? No answer. Right? Now, what is different today? I think in the today's guidelines, it is clear that you will have to tell them the basis of pricing, how mark to market is going to move, and then the corporates cannot say that I didn't understand what was happening. So they have made that much clearer. Why 500 and why not something? Reserve Bank always believes in doing something, it may be less than ideal, but which is more quantitative rather than an assessment or a qualitative. Somebody will have to assess about your risk management. That goes into sort of somebody interpreting it. They would like to have more quantitative parameters, which are easier to monitor. And the question is, at some stage we said a bank which has 9% capital adequacy or 10% capital adequacy alone can offer derivatives. Why? Not because of their risk management abilities, because of their ability to sustain the risk and cushion the risk in their balance sheet. I thought these things must be made clear from the regulator's point of view.
I think, thank you so much, sir. Just one built upon what you just said, and one of the guidelines that was critical is, I think it states very clearly that only when banks are able to value the product, that's where the pricing, that is critical. Yeah, yes. Absolutely, absolutely. I think there were also cases of banks creating an intermediary banks to sell the product. So while there was a relationship between a
Again, the answer we got was we have done a back-to-back hedging. And I myself told them there is nothing in practice which is back-to-back. Yeah. Only you can stand back-to-back, not the day.
Okay, questions from the, yes.
Yeah, good afternoon, everybody. I come from a banking background. Initially, I was with SBI, and from there, in the last part of my, banking job, I was doing this marketing of, derivative products. I have some few observations to make, and that is what I want to do. See, so what was offered initially was exotics in all other currencies, but not in USD INR. The products that were sold as exotics in USD INR were nothing but the leveraged products. They were not truly the exotic products. We badly need exotic products to hedge our risk. So this is one differentiation that I want to make. My suggestion for now, because I have lesser time I have written so many things that I can't speak out everything. What I suggest is devise a course and allow derivatives only to those who pass those courses. This is one thing that the regulators can do, so that you know the suitability much more than anything else. And I think this thing, the liquidity has to be introduced. So some of the banks will have to come and start writing, taking those risks on their books. Otherwise, the liquidity is not there. Even after the guidelines, the liquidity is missing. So maybe they will have, some of the banks will have to be nudged to start offering those products, run the books, and then don't do it back to back. As sir said, back to back means suitability is gone. So if you do it, after running your books, the products will automatically be suitable. So these are some of the things that I thought I would just add.
Thank you so
Just
much.
to your
Abhijit.
point on
Yeah.
liquidity, you're right. Banks, and now we've got PDs also who can participate. So put together, I think the volumes slowly and steadily, once they pick up, the transparency on pricing and all will kind of get addressed. But it's a journey that you have to go through.
Yes.
Any other questions from the audience?
So,
yes,
Maulik,
Jay.
I just wanted to add something which I think Tanushree also touched upon is, say, take a very basic example that in capital markets, right? If you have a dealer who is supposed to execute trade on client's behalf, he is supposed to get certified. There is NISM exam which he needs to pass, then only he is eligible to, punch the orders. And when we're talking about launching of, exotic derivatives and we trying to aim at 5 trillion economy where lot of corporates would get this exposure of, this exotic derivatives product, why can't we have certain kind of certifications for the bank employees or whoever wants to sell this product?
Yeah, I
So
think
this
it's
is
a
just
great.
one
I think
night of
Tanushree,
solution.
something that you were also talking in our side conversations about the courses that we need to have.
So, I think, like I said, FSA exam that is there, right? It's an educational program, and every banker needs to refresh it. It teaches you what these products are. It gives you that accountability. In the past, I know BSc has run programs to educate people on how to invest, so that when a retail investor is investing, they understand the risks, right? And I think those are the kind of courses that we really need. And once you have all the foreign banks, to Mr. P's point, right? All the foreign banks who've actually got these experts sitting outside, why can't they conduct these courses and educate everybody? And those who've passed these courses can then lead the education and awareness of.
Sure.
In fact, just on the point of need, today banks are allowed to lend through Gift City to the Indian MNCs, if I have to say so,
Yeah.
and much bigger set. So if these Indian MNCs, global MNCs, practically today, large institution, if they want to do some sort of hedge on their loans or, so that enabler has just come in about 10 days back from the regulator. So I think we've seen a lot of
Done.
push.
Yeah.
Got it.
Done. We're all done.
It's
Okay,
enabler.
so quickly, just to sum up, we had almost 30 minutes, 35 minutes of conversations. Quickly sum up, regulator has enabled, put the framework in place. Whether the corporates are ready or not, we will see over a period of time. But key here is, I think there is a willingness to look at it. Infrastructure needs to be in place, research, educational piece, overall opportunity, especially the Gift City. I rather wanted to talk more on it. We are talking about, building kind of a solid structure at Gift City. Maybe this is one more opportunity. There's a huge opportunity, a risk management need, sell side, buy side. I think it's all about which wheel moves faster. And with that in place, thank you very much. We are just rushing it. And thank you so much for your patience here.
Thank you so much to all the panelists. I'd like to call on stage Mr. Mahindra Patwari from Nagrika Exports to please come up on stage and present the memento to all our lovely panelists. A huge round of applause for Mr. Mahindra Patwari. Thank you so much, everyone. A huge round of applause for all our panelists here.